Hi, I'm Pattu from freefincal. Today, let's talk about this interesting chart where I have plotted the Nifty 50 equal weight index divided by the Nifty 50 index. The red line is that ratio. We will talk about that and why, if you look at this chart and take it seriously, why I think even though the Nifty is at an all-time high, you should not stop investing and keep on putting in money as long as your financial goal is okay with that. Before we do that, let's quickly talk about this new flexi cap mutual fund category. This is absolutely unnecessary move. When they said the multi-cap mutual funds, it automatically had that built-in flexibility. They had to unnecessarily change that to 25% large cap, 25% mid cap, 25% small cap. Make many investors worried because there are many large AUM funds in the multi-cap category, and even if the AUM is not large, some of them prefer to have a large cap tilt because that's what investors like in terms of lower volatility. And there's having a mandate to invest 25% in small cap just does not make sense to many investors. And also it could land several of the big funds in problem because the 25% small cap would mean their AUM would be larger than the AUM of several small cap funds, and I had written about this before. So now you have this flexi cap category. Now you will have new NFOs. It's just unnecessary. What would be interesting to see is how many of the existing multi-cap funds will issue a fundamental change in attribute and come up and change from multi-cap to flexi-cap, and we'll have to see what are the full changes. If they say that they are just going to change the category but nothing else is going to change, it's fine, you can continue staying invested in it. But if they are going to change the category, they're going to change the benchmark, and they're going to change other things, using this as an excuse, then you will have to take a call depending on what those changes are. So let's wait and see what is going to happen. We are going to definitely, some of the big funds like Kotak multi-cap fund will have to change to Kotak flexi cap. There is no other choice because their AUM is too large. I'll be very curious to see what kind of move AMCs like Parak Parekh would do and so on. So let's wait and watch and judge each fund as per its change. So, alright, so let's get back to this graph. So, the green line is the Nifty 50 total returns index. The black line is the Nifty 50 equal weight index, and I've plotted them since June 1999. So, if you had started investing from June 1999, you would have had better returns in the Nifty 50 equal weight. As you can see, the black line has pulled away from the green line during the bull runs. It does crash down to the green line, but then when there is a recovery, it just pulls up. So as you know that the Nifty 50 is a market capitalization weighted index. This means that just a few stocks, the top 10 stocks, would determine most of the index weight, whereas the Nifty 50 as the 50 equal weight, as the name suggests, will have equal weight to all 50 stocks, so about 2% kind of thing for every stock. And I had been talking about a market imbalance, and this market imbalance can be seen much more clearly by looking at the ratio of these two indices. So the red line that you see here, and the red line is reference to this right vertical scale. The red line is basically the Nifty 50 equal weight index, total returns index, divided by the Nifty 50 total returns index, and you can see this red line has been above 1. So it was a kind of it crashed to below 1 in the 90s, and then once the bull run in the 2000s started, this quickly shot up to above 1, and it has more or less stayed above 1 since then. For the last 20 years it has been above 1. This means that basically that the returns from the bottom part of Nifty or the middle part of the Nifty has been better than just the top part, of course, over the long term. But of course, what those stocks will change. They will keep fluctuating in different parts of the index because the weights will change. But what is most interesting is that the all-time high of this ratio was about 1.66 kind of thing, and that was after the recovery of the after the 2008 financial crisis recovery. The ratio shot up. You can see that whenever the market moves up, when the market moves up, the ratio moves up. Of course, not all the time a fall in the ratio will correspond to crashes. This fall corresponds to 2008 crash, and then you can see there is a recovery, and then this also shot up. But after that, although both the indices kind of moved up, this ratio has been falling. It has been gradually falling. It recovered during 2013ish kind of region, but then it kept falling gradually and so on. But then after, so you see this arrow represents this gradual fall. This gradual fall means that there is an imbalance in the market. That is, the top few stocks of the Nifty have been more stable than the bottom or the middle part of the Nifty. And since about late 2017, you can see a very dramatic drop in the ratio, and that is when you can see the Nifty started moving up based on just a few stocks like Reliance, HDFC, Infosys, and so on, whereas the rest of the market was kind of was in the doldrums. Especially the mid cap and the small cap indices started correcting sharply and so on. That's where this happens. So I had done a study where I said that active funds have struggled to beat the Nifty for the last 7 years, and that 7 years is because that corresponds to this region here. And visibly, for those who have been seeing star ratings, visibly the star ratings of actively managed large cap funds fell to 3-star, 2-star kind of thing, and Nifty and Sensex index funds became 5-star. That's actually when this interest in index investing came. It came for the wrong reasons, in my opinion. It came because they saw the performance, and that's always not going to last. So you can see this dramatic fall here, but then after the market crash, that's in this March 2020, the fall has been arrested, and then there's been some fluctuating kind of region here. Now, if your goal is several years away, and if you have a right asset allocation, the way I would see it is that, look, from this point, I can this red line can of course go down further. But there's a good chance that the red line can move up, and if it starts moving up, this would mean that the market imbalance would correct, and other regions of the other segments of the market would also start moving up, and the bull run would more or less be uniform and not just be dependent on just a few stocks. So based on that hunch, or whatever you want to call it, I would suggest that you do invest more and you don't worry about the Nifty being at an all-time high. Of course, nobody knows where the red line could go. There could be a crash tomorrow because there's a lot of turmoil in the US today, and the red line could go further down. There could be more crashes. All that's fine, but I think this is still a perfect time, if your goals are far away, to not worry about market being high, all-time high, and so on. Just put your money in. Sooner or later, I expect a reversal in this trend. This trend has gone on for quite a while, and there should be a reversal in this trend, and there should be an up move here. And this is actually a very disturbing trend that has been falling since the 2009ish, early 2010ish kind of time. I have been saying this in my Nifty PE valuation videos. I have said several times before, earnings have not been, significant earnings. The last time I saw clearly earnings increase was during this time, but after the crash, after this period, I'm not seeing those earnings, corporate earnings, significantly move up. The market has kind of when the BJP came in 2014, and they came back again. Now there's some kind of euphoria that the market started moving up on that period, at least around the time Mr. Modi was announced as the candidate for I think late 2013, I think. But the market has been going up on some kind of hope, and not based on real earnings. And that's another way. That's another way to see that is this ratio. This fall down is kind of very disappointing. But hopefully it will pick up. The economy will revive at some point, and then this will start moving. And when that starts moving, that's when the big returns will come, hopefully. So yeah, equity investing is about hope, and if your goals would allow for such hope, then there's no reason for you to stop investing. So that's all I wanted to say. Bye bye.